Thank you for joining us on the Q4 and FY18 results conference call of Edelweiss Financial Services Limited. We have with us Mr. Rashesh Shah, Chairman and CEO, Edelweiss Group, Mr. Himanshu Kaji, Executive Director and Group COO, and Mr. S. Ranganathan, President and Chief Financial Officer. We also have with us the stakeholders team, Ramya Rajgopalan, Head Corporate Development, Salil Baba, Head and Senior Vice President, Stakeholder Relations, and Samriti Deora, Senior Manager, Stakeholder Relations. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available on the results documents shared with you earlier. I would now like to hand over the call to Mr. Rashesh Shah to begin the proceedings of the call.
Thank you, Shiv, and good afternoon to all of you. As you would have seen, FY18 has been a good year, good growth year for us. Our consolidated PAT was 890 crores, a YOY growth of 46%. And the key one that we look at is the ex-insurance PAT, which has now crossed 1,000 crores. It was 1036 crores for the year, which was a YOY growth of 44%. So overall, a good growth year. I think one of the higher growth years in the last 7 years we have had. But importantly, in this year, what I'm very happy about is the franchise and advisory business, our fee-earning businesses, asset management, wealth management, capital markets, contributed about 34% of the profit after tax, but in Q4 it was about 40%. So franchise and advisory business now really coming of age, as it is something we have been speaking with you over the last few quarters. Profitability has improved, ROE ex-insurance at 22.1% for the full year, and the consolidated ROE of 17.1%. The ROE came down a little bit in Q4 because of the capital raise that we did in the last quarter. But overall, we are confident of maintaining this going forward. Our ROA were 2.6% ex-insurance ROA and 2% consolidated ROA. So overall, our total assets have crossed 2,25,000 crores, which includes about 55,000 crores of balance sheet assets and 1,69,000 crores of customer assets in our wealth management, asset management, and our custody business. So it's been a great year for us. I mean, it's actually one of the more important years. In this year, we raised 1,500 crores of equity capital in EFSL for the first time. Actually, almost 10 years after our IPO, we raised equity money in Edelweiss Financial Services. So we have grown all this in the last few years without any equity raise at EFSL, and also at a group level, not much capital raising being done. What is also important for this capital raise was we got some marquee investors like CDPQ, HDFC Mutual Fund, Kotak Mutual Fund, and others. Also in this year, we signed a long-term partnership with Indian Olympic Association to be the sponsor for the Indian contingent for the Commonwealth Games, which just recently concluded. We are sponsors for the Asian Games 2018 Indian team, and for the National Games and Olympics 2020 in Tokyo. So our focus on sports, especially sports outside of cricket, more Olympics oriented, has continued to grow, and this was a key year for that. And the last important thing that happened this year is we crossed 10,000 people in the Edelweiss family. So obviously, headcount always comes with its own need of space and infrastructure and attendance compensation cost. I think it also highlights growth, and our effort has also been to create value by providing a great, working atmosphere for people. So the Edelweiss family is now grown more than 10,000 people. The key themes for this year was, one is consistent growth. Our continued 28 quarters, we have maintained our PAT growth at 58% CAGR over 7 years now. and we hope that going forward we will be able to continue to maintain, though our guidance is always to maintain growth in PAT between 25 and 35% consistently for over a long-term basis. So, we also, if you see slide number 16, we have highlighted this, and in the last 7 years, our profit after tax has grown from 128 crore to 890 crores, which is a 7x growth. The other highlight of our business is the diversification we have. If you see slide number 8 in our presentation, that highlights that all the businesses now contribute significantly to our PAT, but no one business is a big contributor. Our asset management, wealth management contributes about 15% to our PAT. Our distance credit is 17% to PAT. Structured credit is 14%. So overall, we have a very, very well-diversified stream of earnings, and with each of these businesses have a lot of headroom for growth going forward. The third interesting element is now our organization is becoming more and more retail. Along with diversification, we also got a lot of focus on retail. Our retail credit over the last few years has grown at 48% CAGR, and even that growth has been, phase 1 was building the platform, and phase 2 was achieving scale, which in this year we have started to rapidly grow that. And even in our insurance business and wealth management business, a retail that we deal with individual customers has been a strong growth area. Our retail credit now is more than 16,000 crores. It is 39% of our total credit book. As you all know, friends, we want to be above 50% of retail contribution of retail credit in the total credit by 2020, and we feel confident of being able to hit that. On the wealth management side, our assets under Edelweiss have crossed 90,000 crores. We started the year at 60,000 crores, so a 50% growth in AUA in this business in this year. And we continue to grow our life insurance business and our asset management business also rapidly. You will see on slide 13, we have made a lot of initiatives in technology, because as we are becoming more retail, we also are investing a lot more in technology, both for operational efficiency, but also for customer experience. And we want to make sure that the entire customer life cycle, from acquisition to experience to risk management, each of these we use technology in a big way. So slide number 12 and 13 also shows the effect of that. Slide 12 shows how the cost-income ratio has also been falling as we've been getting scale, but as also we've been becoming more efficient. The other thing this year has been the franchise and advisory business, which is highlighted on slide number 26. And the profit after tax from this business has grown at 60% on a YOY basis. As I said earlier, wealth management had a 50% growth in AUA. Asset management also, we have now, the mutual fund has crossed 10,000 crores of AUM. It's now currently 11,500. And overall assets under management are now 29,000 between mutual funds and the alternatives that we have. The final theme has been the strengthening of the balance sheet. We obviously spoke about the equity raise that we did, but along with this, we continue to maintain a strong liquidity cushion at 5,200 crores, which is slide number 54. And we have strengthened our balance sheet by more long-term borrowing, which is in slide number 51. So more than 58% of our borrowings are now long-term, which a few years ago used to be under about 35%. So we have significantly enhanced the long-term borrowing, which also insulates us from interest rate variations, but also gives a lot of strength to our asset liability profile. Going forward, friends, India looks very exciting. Financial services continue to look very exciting. We still believe that India will be $5 trillion GDP by 2025, but most of the financial services, whether it's asset management, wealth management, mortgages, SME credit, all insurance, all of this will grow at 3 to 4 times from where we are now. So in the next 7 years, a 3x growth is highly visible. Some of the segment will have 4x growth, and that is very exciting for all of us. Though this growth will come with its own up and down, ability to manage those ups and downs is going to be also challenging but rewarding. We are fairly well placed. We are making a lot of investments. Our new horizon is now 2025. A few years ago, we were looking at 2020, but now we have also changed the goalpost, and we are going towards 2025, and we have done a lot of assumptions around market sizing and all of that, and started to make investments in people, in technology, in platform, keeping in mind the growth that is possible in the next few years. On the asset quality, we are fairly comfortable. We are seeing that overall our own asset quality is as per the plan, as per the business model we have. But even in the environment, though some of the financial services companies have been growing fairly fast, we are seeing that the system credit is not growing very fast. We think the overall system credit is still growing at about 13-14% per annum, which ensures that there is no overheating. There is no undue giving credit to anybody and everybody for artificial growth. So overall system is growing at 13-14, but most of the private sector financial services players are growing at between 25 to 40%, and we are also in that range. And the last part of that is happening because of the NPA crisis in the banking system, especially the PSU banks. A lot of banks are under the PCA framework, which is not allowing them to grow aggressively. And a lot of the good customers of those banks, they need credit for growth, and they are starting to go out. And their credit needs are being serviced by NBFCs and private sector banks. We are also seeing good asset quality traction on the realization from NCLT. There is a little bit of litigation and the testing of the law going on. We remain fairly bullish. In fact, the realizations on NCLT are about somewhere between 10 to 20% higher than what was originally estimated. So that just shows that economy is coming back, confidence is coming back, animal spirits are coming back, and asset quality is also under control. So the other is on interest rates. There is a lot of concern around interest rates going up. Currently, the gap between GSEC and repo rate is about 180 basis points, which is actually one of the highest that it has been in recent times. What it means is either GSEC has to come down or repo rates have to go up. In a way, RBI will raise rates. If RBI raises rates for bond market, it is not a big concern because bond market is already factoring it in, and that is why the gap between GSEC and repo is so sharp. So we don't expect bond market cost to go up a lot. If the repo goes up, the bank cost might go up a little bit, but overall we don't see a more than 25 basis point increase in cost of funds for some of the segments in this year. And that is, in our planning, we already factored that in. And the way our ALM works, that whatever is the increase in our cost, about 50 to 60% is automatically transmitted through the floating interest rate assets we have. So we have to worry only about if there is a 25% rise in interest rate, we have to worry only about 10 to 12 basis points about how to absorb through efficiency and through other innovative product mix changes we have. So we don't see that as a big concern in this coming year as we go forward. And we are confident that we should be able to maintain the credit ROE around 18% with a long-term target on credit ROEs to be about 20%. So overall, friends, good FY19 for Edelweiss, both quantitatively, qualitatively. And as we have said in the past, we'll continue to build on our focus on risk, focus on organization building, focus on people, but more importantly, focus on our customers to continue to deliver value for them. With that, I'll now hand over to my colleague, S. Ranganathan, our CFO, who will take you through the other details.
Thank you, Rashesh, and welcome you once again for this conference call. Let me quickly take you through the Q4 earnings update. I'm happy to announce that we recorded the profit after tax of rupees 248 crores in Q4 FY18, registering a year-on-year growth of 46% against Q4 FY17 after-tax profits. Ex-insurance ROE for the quarter stands at 21.6%. Our total revenue for Q4 FY18 is rupees 2,623 crores, up 35% year-on-year. Consolidated profit after tax of rupees 248 crores is up 46% year-on-year when compared to the FY14 Q4 results of 170 crores. Ex-insurance profit after tax of rupees 308 crores compared to 212 crores in Q4 of FY17 is up 45%. Our balance sheet size also grew by 42% year-on-year to stand at 55,086 crores. This is how our main businesses have fared this quarter. Credit business profit after tax grew year-on-year by 50%. Retail book particularly adding well this quarter. Corporate and distressed credit has also showed significant growth. Franchise and advisory business profit after tax grew year-on-year by 28%. This segment includes fee-based businesses, namely wealth management, asset management, and capital markets. Our operating efficiencies have also improved quite well. The ex-insurance cost-to-income ratio for the quarter was 45% as against 51% in Q4 FY17. Credit costs remain well under control with GNPAs of 1.75% and NNP of 0.7%. The collateral cover for corporate book remains robust at 2.1x and the LTV on the retail book stands at 45%. Consolidated return on assets for the quarter stood at 1.8% and ex-insurance at 2.8%. Consolidated return on equity for the quarter stood at 15.3% and ex-insurance return on equity at 21.6%. Let me now give you some highlights for the year as a whole. Our total revenue for FY18 stands at rupees 8,623 crores, up 30% year-on-year. Consolidated after-tax profit of 890 crores as compared to FY17 of 609 crores shows a 46% growth. Ex-insurance profit after tax of 1,036 crores, up 44% when compared to 719 crores of FY17. Credit business profit after tax grew by 44% year-on-year to rupees 645 crores from 447 crores. Franchise and advisory business profit after tax of 308 crores is up 60% compared to 193 crores of FY17. Consolidated return on assets for the year stood at 2% and ex-insurance return on assets stood at 2.6%. Consolidated return on equity for the year stood at 17.1% and ex-insurance ROE at 22.1%. Consolidated cost-to-income ratio stands at 60%. Let's now look at the individual heads of income for the quarter. Our fund-based income has grown 35% year-on-year to stand at rupees 1,637 crores in Q4 FY18. Fee and commission at 616 crores in Q4 18 is up 28% year-on-year. Our life insurance business continued to be one of the fastest growing life insurance companies in the industry and recorded a net premium of rupees 305 crores during the last quarter, a growth of 52%. Looking at the costs, the borrowings have increased from 33,379 crores a year ago to rupees 47,323 crores in line with the scale of our operations. The finance cost overall grew by 31%. However, the weighted average cost of debt has improved to 9.2% for Q4. Our NIMs also continue to remain strong. On the headcount, we stand at 10,052 as on 31st of March 18 as compared to 6,972 a year ago. This led to a year-on-year growth in the employee cost of 34%. We continue to make significant investments in our key growth areas to build up the scale. Operating expenses excluding employee and the credit cost grew at 28% year-on-year, which is in line with our revenue growth of 36%. OPEX growth is mainly led by higher advertising and business-related expenses and legal fees, especially in growing businesses like life insurance and retail credit. Coming to the balance sheet, we continue to take steps to strengthen our balance sheet. Our consolidated capital adequacy at the end of Q4 FY18 stood at 17.04%. We have a comfortably matched ALM and liquidity profile over the short and medium term. We continue to add new lenders from the insurance companies, pension and provident funds, in addition to the banks and mutual funds, retail subscribers, to make sure that we have a diversified sources of borrowing. Post our last call, we have successfully raised an fresh equity of 1,528 crores at ESSL through a QIP in Q3, with some participation of market investors that Rashesh spoke about. Post-equity infusion, our debt-to-equity ratio, ex-treasury assets, has come down from 5.6 as on September 17 to 4.9 as we speak now. Turning to the credit business highlights, the credit book stood at 42,010 crores as at the end of 2018. The retail credit book comprising of housing finance, loans against property, SME, loans against securities and agri-finance has been growing continuously. At the end of Q4 FY18, the retail credit book size was 16,188 crores. The corporate credit book continues to do well in structured collateralized credit as wholesale mortgages. The book is well managed in terms of credit and risk, and we have avoided undue sector or industry concentration in this book. The asset quality of the credit book continues to be under control with gross NPA as at the end of FY18 at 1.75 and net NPA of 0.7%. The total provision cover stands at 81%. The capital employed in the distressed credit business stands at 6,297 crores with an AUM of 44,100 crores. The cost-to-income ratio of the credit business has improved well and currently stands at 30% for Q4 FY18. Looking at the franchise and advisory business, which comprise of wealth, asset management and capital markets, wealth AUMs stand at 90,100 crores as at the end of Q4 FY18. As you can see, over the years, we have increased the proportion of advisory assets to our AUAs. Also, the net new money has considerably contributed to the increase in AUA during the year. Our asset management business grew pretty well, and we are happy to share that this AUM has grown from 18,200 crores to 29,200 crores as of March 2018. Capital market business continues to be a pioneer and a market leader. Coming to insurance, the net premium for the quarter went up by 52% to 305 crores. The insurance business is claiming as per plan. Edelweiss Life Insurance has a net worth of 1,156 crores as on March 2018. We are happy to also report that the embedded value of our life insurance business stands at rupees 1,635 crores as at March 2018. With this, we complete the Q4 review. We are open for question and answers.
Thank you very much. We will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. We take the first question from the line of Avinash Singh from SBI Cap Securities. Please go ahead.
Yeah, hi. Good set of numbers. Congratulations. Few questions. The first one is that the on-balance sheet loan growth in the wholesale segment, that has come significantly higher because I guess earlier we were thinking to sort of a securitize or take that to fund and on-book loan growth to be in the range of 20%, and now it is close to 40%. And that has led to increased capital consumption. And again, our Tier 1 ratio is where it was at FY17. So sort of some color on what exactly is the strategy regarding this on-balance sheet loan book growth in the wholesale segment and our capital position. That is my question number one. A second question is again sort of a guidance in terms of credit cost. So, I mean, overall credit cost has increased in FY18, and particularly if I work out the number in the wholesale segment, there seems to be sort of a spike from close to 190 basis point in FY17. Now it looks closer to 300 basis points for FY18. So, and there also we have seen a strong loan book growth. So, I mean, Is it something that we are compromising on the credit quality? Because, the provisioning cost is going high and we are still growing at 40%. That was my question number 2. And one more. Third question is that what amount of capital you have infused in the general insurance business and what kind of capital burn rate you see over the next 2-3 years? Thank you.
Thanks. I think the first one, we still expect our on-book corporate credit book to grow at about 20% or so, which is what we've been guiding. We have had a good year in that because I think we had the capacity, plus we are seeing a lot of very high quality opportunities in the corporate book also, especially in the recent last few months as RBI has strengthened their reviews. A lot more corporates are becoming proactive and the need for structured credit. See, again, a lot of these are high-quality borrowers who need a loan which is structured as per their cash flow needs. So there is good quality collateral, but there is a lot of structuring also that goes into this. And this market is actually growing much faster than what was originally happening. So for all around us, we see a huge amount of demand for corporates. Just to step back, what used to happen earlier in the banking system is people were giving a standard, plain vanilla, unstructured kind of a loan, and then when there was a cash flow issue, people thought we will restructure it. Now that has gone away because you have to plan for what the cash flows are going to be at the time of underwriting itself. And that has been our skill set over the years, that it's not that you can earn a higher yield because of higher risk, but you earn a higher yield because you are structuring the loan as per the cash flow availability of the customers and ensuring that you have enough good quality collateral and earning a good yield and all. So that market is doing very well. We are raising some funds also, so we expect that we and our funds put together will be able to capture this market, and long term we will end up growing at about 20% is what our expectation is. But we're seeing very good demand, and in this quarter we ended up actually booking some of the loans which were going to be in April, which came in March. So as a result of that, you might see this growth, but our long term trajectory is going to be that. Along with that, our expectation of retail being more than 50% of the total credit book, also we are on track for that. So that will happen. Retail will grow a lot faster than the corporate book. In terms of credit cost, this is also the year though we have a lot of collateral and we can recover the loans. Wherever we saw a little bit of edginess also, we have provided for that, because our entire risk management approach has been first is client selection, then structuring as per the cash flows of the client, then post-disbursement risk monitoring and management, and fourth, aggressive provisioning so that you are never under-provided for any eventuality. So our internal target has been that provide first and then when you recover you can write it back. So we've been more aggressive in providing in this year, and we have the earnings and all that, so we will continue with that we would rather provide aggressively than hope to under-provide and recover the money afterwards. So I think what you are seeing in credit cost is actually that only, especially on the wholesale account, though we are not seeing any real loss out there. We have just earmarked whichever accounts were on the edge as NPAs and started providing for those. The last piece on the general insurance, we expect to burn about 50 crores a year for the next 4 to 5 years. We are hoping for a break even at the end of 5 years, and the operating burn should be about 50 crores a year on that.
Okay, so just follow up. The first one, that because of this loan growth, the entire thing, that our capital ratio tier 1 has come to 14%. So what sort of a capital strategy we have? And on the last question of general insurance, would you be looking for a partner, again a strategic partner there? So 2 questions.
Yeah, we have been talking to a lot of people. In fact, the current capital that is available globally for private credit, especially this kind of wholesale deals which earn you 14, 15, 16, 17% return, is actually very, very high. And there are a lot of global funds who are talking to us. So as and when we see the right partner and the right opportunity, we'll be able to do that. As you know, we already have a few funds under management where we already partnering with the Canadian Pension Fund, and on the real estate we are raising a $800 million fund. So I think capital is available, and interestingly, this market is starting to become interesting because, as I said earlier, the banks have not been good at structuring, and now structuring is becoming a key requirement for most of this kind of corporate loans.
Okay, my question was more on, equity rate side, because, our Tier 1 capital ratio is now 14%, again, back to that FY17 level, and this kind of growth, again, it will need further equity.
Yeah, I think our overall capital adequacy is at 17%, which is still adequate for at least growth for the next year to 18 months, even at this clip. And on the retail side, we continue to grow, especially in housing where capital adequacy is lower. What is more important is to look at the debt equity, which is currently at about, on slide number 52, on slide 52, which is at 4.9. And we can go up to 6 on this. So we are good for the next year to 18 months at least, even at this clip. And as you very correctly said, we can always sell down and securities is loan if at all we feel that we don't have enough equity. But currently we are not worried about not having enough equity. I think the environment is doing well, and we should be able to maintain overall growth rate. So as I said, credit growth rate on corporate, we maintain only about 20% or so is our expectation going forward.
Okay. And any strategic partnership in general insurance you are looking for?
We are not looking for. I think there's a lot of them are coming and talking to us, but currently our intention is to go on our own for the next couple of years.
Okay. Thank you. Thank you a lot.
Thank you. We take the next question from the line of Renish Bhuva from ICICI Securities.
Yeah, hi sir. Thanks for taking my question. So just to follow up on the credit growth side, so I understand that we have been growing pretty aggressively on structured credit part because of the vacant space. But even if you look at the wholesale real estate, the incremental disbursement, net disbursement in Q4, appears to be a little higher of close to about 2,000 crore. Vis-a-vis, if we look at the last 3 quarters, it's been pretty flat. So can you please throw some light on the incremental players or, average ticket size, etc.?
No, I think there were a couple of them. I think one was in the last quarter. The earlier quarter, we were going slightly slow on some of the proposals because we were busy with our own equity capital raise, and we wanted to first complete the raise before we activate the pipeline. So the pipeline was fairly healthy, but we were not moving very fast on that. Once we got our capital raise done, we had the room on that, and along with that, in this quarter, the market also expanded, and we got some very good opportunities. So on wholesale, we'll always see a quarter here and there where things will get bunched up. So I wouldn't see a lot in the fourth quarter. I think if you see combined of third and fourth quarter, we are fairly okay. So it is still slightly higher than what our earlier rate was, which is largely because the market has opened up. But in third quarter, we were slightly slower.
Right. But sir, just wanted to get a sense, though, the incremental disbursement is actually, as per our defined policy, and it is not that, because of the higher ticket size, we have seen this growth. I just wanted to get
No. It is as per, actually we are doing the same thing. In fact, we have raised the bar because the pipeline is so much healthier. So we internally monitor something called origination to approval ratio. And we were always operating at about 25%, which means if we originate 1,000 crores worth of loans, we only approve 250 crores.
Right.
That actually has improved. We are now at about 18% or 19% approval rate from origination. So the market has become more active. So the origination or the proposals that are coming have expanded a lot, and we have actually tightened it to just cherry pick the high quality risk return reward opportunities that we have.
Right. And also, just a follow-up on the retail loan growth side. So retail loan growth for FY18, is pretty robust at 80% almost. And most of it is driven by the loan against share, which has, almost doubled during the year. So going forward, sir, do you think this kind of traction in this segment to continue, or there should be some moderation going forward?
See, I think it's an important question. If you see overall, our retail credit book also grew at 81%. Our current target is about 45 to 50%. So that extra growth that happened against loan against shares. But a large part of loan against shares is our product called ESOP financing. As you may know, we are the leaders in ESOP funding. And I think given the way the market was last year, we're seeing a huge amount of market demand on that. These are usually executives of companies who are exercising ESOP, and we fund their exercise of ESOP. They normally hold it for a year to get their long-term capital gains, and then they sell. And in return, they also become our clients on the wealth management side. So we are the market leaders in ESOP financing product. We've been in this for the last 8 years. And this year we saw a strong growth in the ESOP funding, which is actually very refreshing because it just shows that the Indian corporate sector is also coming of age. And the kind of, a lot of the large companies, I think in the BSE top 300, 400 companies, a lot of them now have ESOPs that they offer to their employees. And we see this also as a fairly good opportunity. If you look at globally, go to the US, most of the wealth managers have something called stock plan business and stock financing business. This is becoming more and more similar to that. So we are actually very pleasantly surprised at the growth in the ESOP funding business, which is a lot more steady and secular, unlike your normal margin funding business. Margin funding business goes up and down, but more than margin funding, ESOP financing is a more stable business.
Right. Yeah. Sir, as you rightly mentioned, that margin funding is pretty much capital market sensitive business, as against ESOP funding. So, going forward, what sort of growth you expect, especially on the loan against share? I mean, 100% every year, I believe, is not, doable, but...
I don't think we want to grow. As I said, we want to maintain our overall retail credit growth of about 40-50%. So I think we will be happy for anywhere between this part of the business growing at even 30-40%, because I think SME and mortgages and now the agri will also start growing a lot more aggressively.
Right. Okay. Right, sir. So now just last question, if you can allow me.
Please.
Yes, sir. So on wealth side, so though our AUM has grown like almost 50%, but if I look at the net revenue side, it is, the growth is a little lower than the overall AUM growth. So, sir, what might be the reason? I guess, mathematically it's purely because of the lower asset yield on the incremental, wealth which we got. But you can just highlight, a little insight into it. Would be more helpful.
I think again, you will see AUM growth versus you will see average AUM and all. Mm-hmm. So I think our average AUM, as it will not be 50% growth, it might be closer to 40% growth. And the yields also might be lower by about 5 to 10% than what it was last year.
Correct.
Because there was a rapid growth in the second half, so we didn't get the benefit of that for the whole year. So I think when we internally look at average AUA, not the end of period AUA. What is currently in the presentation is the end of period AUA.
Right. Absolutely right, sir. Okay. So this is just because of the lower average AUA growth than what it appears on the year-end numbers, basically.
Yes.
Okay. Thank you so much, sir. Really helpful, sir.
Thank you. We take the next question from the line of Subramaniam Iyer from Morgan Stanley. Please go ahead.
Hi, Rashesh. Congrats on a good set of numbers. So first on the asset quality bit, take your point on the higher provisioning this quarter, but also, if we run some rough computations, we find that there's a rise in NPA formation as well. Also noted this in the fourth quarter last year as well. So is it some kind of a recognition of weak accounts or something, proactive classification of as NPA, or how should we read it? So that was one question. The other question I had was basically if you could provide a split of your credit cost into retail, wholesale, and if at all there is some provisioning on the ARC side as well. And my last question is basically some guidance into how should we see things under Ind AS.
So I think on the first one, as I said earlier, we have been, classifying accounts and just providing for that because as over the years we have seen that is usually a much actually better way of managing the risk than trying to hope that you will, recover and try to push the can further down the road. So we have, if you see on slide 30, our provisions and the write-offs are now 616 crores for the year. So this is what we call the credit cost. And the kind of NIMs we have, we actually budget this credit cost in the NIM itself. Our average expectation is our credit cost, actual credit cost should be about 50 to 60 basis point of the loan book. We are currently providing 125 to 130 on the closing, credit book. If you take on the opening book, it might be about 200 odd, basis point on that. So we are providing for that with the intention that as we start liquidating this collateral, we can start getting the clawbacks on that. Because you will see most of the banks, there are two kinds of approaches most people follow. One is to provide as required, and the other is to provide ahead of the curve. We have always followed the process of providing ahead of the curve. In terms of the credit cost between wholesale, distress and retail, I think approximately, and I'm giving very approximate numbers because we don't have the exact breakdown, about 65 odd will be the wholesale side, and the balance would be equally divided between distress and retail side in terms of the credit cost that we have. And we think we will maintain that as we go forward. So as I said, our actual credit cost we expect to be about 50 basis point of the loan outstanding on any given year. And that is how we do the internal yield analysis and all. But the idea is to provide more and be more conservative on this.
Thanks. And my last question was on the Ind AS impact.
Yeah, Ind AS.
Yeah. In terms of Ind AS preparedness, we have been doing the parallel runs for the last several quarters now. And in terms of infrastructure building, we have almost all of us going through the courses on Ind AS, and we are prepared for that. While we do that, there is also regulatory requirement, the regulatory clarifications which are yet to come out that will help us do the impact analysis. But at the same time, we also understand that some of the NBFCs and the ARCs have approached the MCA and the RBI, and in all probability that should get deferred, similar to that of the bank. But in any case, even if that comes about in the first quarter, we are prepared for that. The impact of that will be very negligible when it comes to the opening balance sheet.
Sure. Thanks. That answers my questions. Thank you.
Thank you. We take the next question from the line of Ashwin Balasubramaniam from HSBC Asset Management. Please go ahead.
Yeah, hi. Just wanted to understand in terms of the credit book, the average interest yield which you've disclosed is about 16.3% for FY18. Like across various segments like, let's say, mortgages, SME or wholesale and structured, how would the individual yields look like? Because if from what I can see, the retail and retail mortgage and LAS book has been the one which has grown significantly, and those I presume would be at a much lower yield. So just wanted to understand like how segment-wise the yields will look like currently and also like on the book and incrementally.
So if you look at slide 25, we have tried to give the breakup between retail, corporate and distress. We have not given the yield as such, but we have given the NIMs on that. So on the retail book, we're making NIMs of 5.2, On corporate, it is 9.4, and distress, it is 9.1. And we have, different gearing and cost income in each of that. And we look at ROE. So the retail book for this year made an ROE of 15.8%, corporate made 18.8%, and distress was about 20% ROE. And that cumulatively on a weighted average basis ended up at 18.1% ROE for the credit book as a whole.
Okay. So between corporate and real estate, on the wholesale side, the yields or the NIMs would be roughly similar? Or
I think real estate are usually 100 to 200 basis points higher.
Okay, got it. And on the corporate side, would you have any exposures to, let's say, any of the accounts which are under various restructuring dispensation of banks? And consequently, is there those accounts which might, maybe come under stress, or you might have to recognize the NPA going forward? Or the other question was also would you also have any exposure from this part of the book onto companies which you might have acquired in the in the ARC business where you've acquired the security receipts? So would you have done any kind of lending to those companies?
See, we basically lend to promoters and business groups at a group level, and we have collateral or we will have either really separate collateral or identified assets which are clean and all, which are not under stress, and the cash flows of those are earmarked to us. So a lot of groups may have some other companies which are maybe in NCLT or restructuring, but the assets that we have are usually very healthy. So as you know, all groups have a few companies which are very healthy and a few companies which are currently going through restructuring. So we usually work with very good quality collateral, with good quality promoters, and just ensure that our collateral, our servicing is all fairly ring-fenced, and we have not had any issues on that. So assuming there is a corporate group which has maybe some companies under restructuring, but the same corporate group has an asset and office building which is unencumbered, and that is held by the group holding company. If they come to us and want to borrow against their office building or those earmarked assets, we would consider that, because we are not exposed to the underlying stress of the operating companies which are under NCLT or restructuring. We are getting very ring-fenced, unencumbered, clear-cut, no issues kind of a collateral. We would look at it, of course, subject to the quality of the client being good, because we also are very strict on client election. And over the years, even if there was good quality collateral, good quality servicing capability, if we are not comfortable with the client, either their track record or their business, approach, we would usually avoid those.
Okay, got it. And would there be any exposures you have taken to companies where you've acquired like security receipts through the ARC? Would the corporate book have any such exposures or no?
No, the corporate book is outside of this. The corporate book has done some interim funding of companies in NCLT. As you know, when a company is in NCLT, the company as per law is allowed to borrow money in something called interim financing. That interim financing is the senior most financing and gets paid first along with the fees of the RP. So it is usually not a risky proposal, but you have to structure it well and all. And we have done a few of those around, 50 crores, 100 crore kind of deals in some of the NCLT where we have provided these super senior interim loans. And they are all safe. They are getting service regularly. The repayment will come as per schedule, so there are no issues on that. And these are usually monitored by RP and the NCLT. So these are very strongly adhered to. We are not giving the loan to the old promoters. We are giving the loan to the resolution profession monitored company inside NCLT now. It is as per law. If you see the IPC code, there is something called interim funding. In fact, there is a large need for interim funding that is starting to grow. for the companies which are in NCA. And we have actually developed expertise on that. So we have about totally exposures on that, not a large amount. Total amount may not be more than 250 crores.
Okay.
But we are also currently leaders in providing interim financing also.
Okay. Thank you.
Thank you. We take the next question from the line of Nischint Tripathi from Kotak Securities. Please go ahead.
Hi, and congrats for a great set of numbers. Just going back to slide 25, I'm looking at the corporate part, and just wondering, if I just kind of try to do some very rough numbers, your expenses that are allotted to the corporate segment would be somewhere close to around 900 odd crores. So just trying to understand as to, what are these expenses like?
No, it is, our cost income ratio is 31% of the net interest income of 1,462 crores.
Yeah, so actually if you look at it, 1,462, even if I take a full tax rate, your PBT should be around 500 odd crores. So that's what I said that, you're somewhere close to around 900 odd crores of expenses that are allotted here.
Yeah, because you also have to take the credit cost. As I said earlier, if you look at our credit cost of about 600 crores, about two-thirds of that comes from the corporate side. So when you look at the net interest income of 1,462, you should take out another 450 crores of credit cost and the provisioning that we have done, and another 400 odd crores of expenses, which is a cost income ratio, and then you will come to the PBT.
Sure.
Yeah, is it clear, Nishan?
Yeah, just one point. How many exposures would you have in terms of number of loans in this segment?
On the corporate total, we should have about 60 on the corporate side and another 50, 60 on the real estate side. So total about 110, 120.
Sure. Just now moving to the insurance business, I don't know if this was discussed earlier, but what has kind of driven the growth in IEV, and are you sharing anything on the VNB margins?
This year we have not shared on the VNB margin, but we are planning to now start showing that going forward. But there are two VNB margins we calculate. One is pre-expense overrun and other is post-expense overrun. I don't know the exact numbers, but I remember from the board meetings that we had. So we will be happy to, I think, send it across. But we are at about 32% VNB margin on a pre-expense basis and about 18 or 20 on post-expense basis. But we can send this across. And the Indian embedded value, I think we've disclosed that, is 1,625 crores and 35 crores now.
So what is, because the jump on a YY basis is kind of, fairly high, so that's why we were a little curious.
Yeah, actually, IEV is also because of the capital infusion that happened in this year.
Okay. Sure. Just one or two small questions. On the SME side, how much business is unsecured?
Our total SME book, if you look at that, slide number, the credit book, if you look at, 29, our total SME book is about 3,600 crores. I would say approximately about 1,500 is unsecured, and the balance will be secured SME loans.
And on a net basis, your yield is 11% in this, is it? Including unsecured?
No. I think unsecured, if you look at slide number, number 32, we have actually given both of that.
Yeah. Sorry.
On unsecured, we make 20%, and on the secured, we make about 13%.
Sure. And just finally, on the wealth side, of the total net new money that you mobilized, which is around 15,000 odd crores, how much could have been on the ultra HNI side and how much could have been on the mass affluent side?
I don't have that breakup here with me. But we can try and calculate and give it. we don't split that up as much.
Sure. No problem. Great. Thank you very much and all the best.
Thank you. We take the next question from the line of Vishal Modi from Maybank. Please go ahead.
Yes, hi, good evening, everyone. Just one question on the distressed equity. The net increase is around 254 crore. So just wanted to check, this is due to conversion of CCPS?
You are on slide number
25.
Yeah.
The 1177 crore, the net worth of the distressed business.
Right.
It's increased by around 254 crore from last year. So just wanted to check, fresh capital infusion has happened in this segment?
Yeah. So if you see, when we did the transaction equity deal with CDPQ, we had sold 20% of the equity of ARC for a realization of 500 crores. So they were investing 500 crores for buying 20% of the company. The company was valued at 2,500 crores on post-money basis. But out of the 500, the structure was that 300 will come in the at the time of investment, and then they will invest another 65 crores every year, subject to some basic parameters, and we will be hitting those all those parameters. So they put in another 65 crores in this year. So if you take the retained earnings as well as the 65 crores infusion from CDPQ, you will explain the increase in equity.
But I think last year the net worth was 730 and we had around 192 this year. The PAT, I don't know what would be the retained earning out of that. So still there is a little higher, so just wanted to check.
No. The last year that equity was average equity for that. If I am mistaken, let me calculate. Sorry, I'm not sure. You have the last year's figures with you? Yes. We just calculate and explain it to you.
Sure. My question was that since we would be seeing a lot of opportunities coming up in fresh asset acquisition, so what kind of capital requirement would this business require? And probably what is the shareholding now? It used to be 74 or 75. So as the dilution or conversion of CCPS happens, eventually we would have how much on the fully diluted basis?
So the conversion of the CCPS will not happen, but we are counting it as equity because it's a compulsory convertible preference share. We are seeing a lot of opportunity, and the distress, the ARC business is structured as an NBFC itself, and it is subject to the same norms as an NBFC from capital adequacy and all those points of view from an RBI. From RBI. So I think our current equity that we have of 1,177 crores is currently adequate. And SR will just explain to you the increase in equity from 731 to 1177. Go ahead.
Vishal, as Rashesh did talk about, 731 was the last year, and now it's 1,177. So that's roughly an increase of 445, which is explained as under. The PAT for the year was about 200 crores. The CDPQ money that got converted was about 65, and out of the infusion that we had, Edelweiss in turn contributed to the capital of ARC about 180 crores.
And we now own 60%. I'm saying after all the conversion is over, from a beneficial point of view, we own 60% of the ARC, CDPQ owns another 20, and the other old HNI investors own the remaining 20 on that. So it's now going to be 60-20-20.
Sure, got it. Thank you so much.
Thank you. We take the next question from the line of Umang Shah from HSBC.
Yeah, hi. Thanks for the opportunity and congratulations to the team for a great set of numbers. I just had a couple of questions. One was on the credit business, as Rashesh mentioned in his opening remarks that over the course of next few years, we want to see this book inching up to almost 50% of the overall book. But at the same time, we intend to maintain or improve ROEs from 18% levels. Clearly, credit business has kind of lower ROEs compared to the other two businesses that we are into. So how do we intend to maintain 18% ROEs or rather improve that?
I think on two fronts. As you said, we've been currently providing a lot more aggressively. So our credit cost and all, we expect as we have already built up this cushion, will start stabilizing. And second, the cost income ratio. If you see slide 25, the retail cost income ratio is 46%. As we get scale in that, because a lot of our businesses are still much smaller and we are still opening branches and all, so to grow at this pace. So the cost income ratio also on a long-term basis for retail, because retail includes both SME and housing. And housing, as you know, the cost income ratio should be about 20% or so, and for SME should be about between 35 to 40%. So we expect this to stabilize at about 30%. So what will improve will be the cost income ratio, the credit cost that we incur as we get scale in this is what our expectation is, and hence we will be able to maintain the ROEs. Also the distress, as you know, there is some amount of back-ended profit that comes when the assets actual recovery happens. So there is a carry element of that. So the ROE on the distress should also improve in the next 3-4 years as the recoveries start getting stepped up. Like in this year also we had good recoveries, but in the coming 3-4 years, we expect some fairly good recoveries in the ARC book, and that will also improve the ROE. By our expectation is, I don't want to give any forward-looking statement, but should improve by 200-300 basis points as per the current model we have on the ARC. As you know, ARC, we earn a steady yield coming out of fee and interest income that we get. And then when the actual recovery happens, you get some extra carry, you get the performance incentive that comes with that, which is the extra ROE that you will make in the ARC. So I think going forward for the next 3 years, retail will go up, cost income ratio will come down, credit cost should come down, and the distress ROE should improve.
Perfect. This helps. My second question was on distress assets. In fact, we have kind of remained stable at around 440 billion rupees worth of assets sequentially. What's your outlook in terms of acquisitions? What kind of book growth should we see here in terms of recoveries? You have already indicated right now that you expect recoveries to be strong over the next 1 to 2 years. But on acquisitions, how should we see the book growing?
See, you see the ARC market or the distressed asset market in India, last 5 years, about 20,000 crores of cash has gone in, out of which our own has been about 6,300 crores from our book and another 500-600 crores from the funds that we manage. So altogether, 7,000 has been invested by us. And overall, 20,000 crores has been invested as cash invested for distress opportunities in India. Going forward, we think the market is good enough for 14,000-15,000 crores of new cash going in. As I said, there are opportunities in interim funding, there are opportunities in the new ones, even the companies that come out of NCLT, they also need some structured funding and all. So there is going to be a lot of opportunities where existing ARCs which have an exposure can play around with that, because you can continue a loan, you can do some new structures on that. So I think about 14,000 to 15,000 crores of cash investment opportunity for the industry as a whole in distress will be there. Our expectation is that can we do about 3,000 crores a year, out of which approximately 1,500 from our books and another 1,500 from the funds we manage. If we can get that out of the way, I think that would be a good thing. And I don't think that is very hard to do. I think the pipeline we are seeing, the kind of the distress assets which are still there. And I think the new FY18 circular and all will give a strong, will propel this market even further, because earlier only when things become NPA and NPAs, people have started working on that. But I think now from the default stage itself, the banks will want to clean up their books, or the companies will also want to ensure that they don't get forced into NCLT, and they will need some restructuring capital ahead of the curve. So I think we expect this to be, be growing about 20-25% a year in terms of the corpus we have, which should be possible.
Fair enough. Sounds good. And sir, my last question was on from the capital allocation and console ROE perspective. So FY18 we have ended at about 17% ROEs, and we have seen on an incremental basis a significant part of capital being allocated to the insurance business. Now clearly on the credit as well as on the distress assets business, we are growing fairly strongly and actually quite profitably as well. Just want to understand that how do we see the trajectory for losses in insurance over the next 2 to 3 year period? So to that extent, clearly we see some kind of plowback in terms of our return ratios, and incrementally, given that we are looking at about the kind of capital requirement for the distress business as well as for the credit business, should the next capital raise would be like about 18 months down the line, or you think the plowbacks would be strong enough to kind of sustain us for a slightly longer period of time?
I think on your first point, we are not allocating more capital to insurance. If you see slide 24, you might have seen the equity in insurance going up, but what you are seeing there is the free minority, because our partners Tokyo Marine infused capital in the insurance business. You might see that. So overall, from Edelweiss, we have only allocated 150 crores for the life insurance business and another 100 odd crores for the general insurance business. So we don't expect to allocate more capital to insurance business for the next year going forward. So almost all the capital will get allocated for the credit businesses, both retail, wholesale, and distress. All of that. I don't think any of the other businesses will consume any equity capital for the next 18 months at least. You are correct. I think if you continue to grow at this pace, we might need equity raising about 18 months down the line. And it is at that point that we have to decide whether to raise capital at the holding company level, or should we raise it in one of our subsidiaries in the credit side, which is able to consume capital and grow. So we will make up our minds, but I think for the next year at least, we should be able to maintain a good growth rate and still have enough equity for that.
Perfect. And so just the last point, console ROEs, you expect that to improve from 17% to about 18 to 20% over the next 2 years? Doable?
As you have seen in that slide number 17, we have already indicated that we want ROEs to improve, and we want our console ROE to be 18 and above. And I think 18 to 19 is the console ROE, and about 22 to 24 is the ex-insurance ROE target that we want to have internally.
Perfect. All right. Thank you so much, and wish you all the best.
Thank you. We take the next question from the line of Qtr4 from Emkay Global. Please go ahead.
Thank you for the opportunity, sir. Hello?
Yeah, hi.
Yeah, thank you for the opportunity, sir. If I can direct your attention towards page 21 of the presentation. Your PAT for FY18 in the credit business, it's 645 crores, whereas on page 24, it's 731 crores. So there's roughly a difference of 86 crores. You can help me.
I think what we are seeing here on 21 is after the minority interest, because this is just breakup of our 890 crores PAT. So this is after the minority interest, because as you know, in our ARC business, we have 40% equity which is held by others. So it is there. While what you are seeing on page 25 is before the minority interest.
Okay, and can you give me the bifurcation of your balance sheet size of the non-lending business?
Sorry, we couldn't hear you. Can you speak up again, please?
Can you give me the bifurcation of your balance sheet size of your non-lending business?
We have done if you see the equity allocation, we have given it in the slide out there. This is slide 24 and 26 will give you the bifurcation. No, he wants the balance sheet size. So we have given equity because outside of equity, there is not much that is there in the other businesses. All is in the credit and the balance sheet management unit. So if you see the reported results, we have given segment-wise, you might get it in that.
Okay, fine. Thank you.
Thank you. We take the next question from the line of Shweta Tattaras from Prabhudas Lilladher. Please go ahead.
Good evening, sir. Congratulations on good set of numbers. My question pertains to the distressed asset business. So what percentage of bank auctions have you applied for as at the end of FY18?
Actually, almost all the assets that we buy from banks are all through auctions only. Now auctions have become the norm for the banks. So almost everything that we have bought has been in the auctions only.
So you cannot quantify as such. Because I remember you putting up a number in one of the analyst meets wherein I met up with you. So you had mentioned you had applied somewhere between 25 to 30.
So I don't have that number. We don't track it because in a lot of when the banks announce auctions also, a lot of them you don't participate because the assets are not good quality. So I think we are now increasingly buying asset by asset, but each asset we buy is also auctioned by the bank. So we would have bought about 12 or 13 accounts in the last quarter by just off the cuff. So those would be the accounts we would have added. But a lot of those could be incremental. So like we already have SR Steel exposure, but let us say from Indian Overseas Bank we bought SR Steel. So we had already had some exposure to SR Steel that we had bought earlier. We may have bought another one bank. In the last quarter, we bought from J&K Bank also the SR Steel exposure. So those way, I think we would have added about 12 or 13. We would have done 12, 13 purchases in the last quarter if I were to quantify those.
Okay, great. So now that CDPQ is on board, so is it that the asset acquisition value will go up going forward?
We will try and buy more for cash. So earlier we were doing 85-15. Now we also offer to banks if the price is right at 50-50 also. We also happy to buy 100% cash. So between us and CDPQ and the funds we manage, we now have more than about 12,000 crores of cash available. So we are able to offer banks all kinds of structures, either 85-15 or even all cash, as long as the price is right. So I think our ability to show more cash to banks has gone up. You are right.
Okay, sir. So my second question pertains again to the asset quality of the credit business. So just one question there. What explains the collateral on corporate book that has declined year on year? The collateral cover. I'm referring to slide 31. Yeah.
Huh?
So I'm referring to slide 31.
So actually, it goes from deal to deal. So there is no real focused answer for this because on every deal, we are somewhere between 1.75 to 2.5 times. That's our normal range of collateral cover between 1.75 to 2.5 times. So it just as the portfolio keeps on varying, it goes from 2.1, 2.2 to it has not ever gone under 2. The average portfolio cover has never gone under 2. But between 2.1, 2.3, it can keep on varying as we keep on doing the newer transactions. And it can keep on varying on that.
Correct. So then lastly, in the franchisee business, so wealth management is the one which is actually stacking up your cost income ratio, which is spiked up. I mean, it's commendable that it's come down from 85% to 65 odd percent. But then is it because you're scaling up the relationship based model, which focuses more on mass affluent relationship managers and mass affluent clients and relationship managers? And where do you see this 67% kind of cost income heading to going forward?
No, actually, Himanshu, it is a combination of things. There is obviously our focus on mass affluent where the relationship manager costs are lower, but our overall cost to income ratio and extensive use of technology in this business that we have been able to do is actually bringing the cost to income down, and that is why the margins are.
On the long-term basis, we expect cost to income for this business to be up between 50 and 55.
Okay. Okay. That's from my side. Thank you, sir.
Thank you. We take the next question from the line of Manish Shukla from Citigroup.
Good evening and thank you for the opportunity. First question is on the retail business. As you look to scale up your retail to roughly 50% of your overall assets, how do you see your sourcing panning out? Because that will have cost implications.
True. I mean, as you have seen in retail in the early days, a lot of people will be reliant more on open architecture structures. In the mortgages and all, we now do a lot more direct. Especially we started doing under construction, which has become more also direct oriented, and we also set up a direct team for that. So now I think mortgages, we expect that our origination should be, currently it should be about 65-70 direct sales agent, and the remaining should be from Edelweiss cross-sell and other direct sales. Our long-term target is to be at about 50-50, where you are getting 50% from DSS and 50% from your own direct sources. On the SME, we are already at about 50-50. We have already set up our direct sales team from the very beginning in the SME business. And SME, we would, I think, on a long-term basis, go towards maybe about 65-35, 65 being direct and 35 being through open architecture sources.
Because what we
but the cost on that ultimately ends up being the same. One is fixed and one is variable. What we have seen is that in the early days, you see a lot more proposals through the open architecture. So while you are finalizing the programs and all, it's actually good to peek around with that. But as you go forward, as you are very clear with the client segments you have targeted and all, it is a lot more efficient to go through your direct sales channel. Your approval ratios of direct sales channel are much higher than the approval ratio on the direct sales agent channel. So that adds up with the cost. But when you add up the cost overall, we don't see a big difference in cost. We just see that the direct channel will give you more control, will allow you to experiment more with your customer market segment and creating products for that. And your customer experience is more in your hands.
Fair point, but especially in the SME business, as you move from DSA to direct, it is bound to see some kind of a portfolio churn because a customer segment which is used to DSAs as a model, you could probably end up losing it. So that on an expanding balance sheet, I'm not sure how that will have an impact on the business.
So we will not move away from DSA. That's why I'm saying some DSA will remain. We are just expanding into new, and especially in a lot of other cities where we open branches, we are using more and more direct also. So we will not give away, because ultimately we now have about 100 branches. A year ago we had only 30 branches. We will add another 100 branches in the next year or 18 months. So as we are going into newer cities, in those cities we are doing more direct than using the direct sales agents.
Okay, and just to be sure, we are talking of only the existing product lines, right? We are not thinking of adding new product lines within the retail segment.
Yes, we are currently not contemplating adding any more because as you can see in each of these, we are still fairly small. I mean, if you look at our SME, the secured book is about 2,000 crore and semi-unsecured is only 1,500 crores. Even our home loan mortgage books and all. So we are still fairly small and also relatively subscale. So I think the next couple of years, the effort will be to just get scale into all this business because we made the investment, we opened branches, we created, product programs, we put the platform in place. Now we just have to scale up.
Okay. On retail, what would be the rough split between home loans and LAP?
Home loans is much smaller. So out of the total retail book of 3,600, I would say about 1,000 to 1,200. About a third will be home loan and 2/3 will be LAP.
Okay. My next question is on distressed business. I mean, most of us would want to believe that we are in the last leg of the NPA recognition cycle and probably most of it should be done over the next 6 to 12 months. In that case, if you look towards fiscal 20, what do you think will drive the distressed asset book? I'm assuming that the lending part would be taken care of the corporate credit book. So from a distressed asset perspective, from a growth perspective that you said about 20-odd%, I'm just wondering what will drive that kind of a growth.
So a couple of things. I think first is the banks still have to sell for the next couple of years because they still have a lot of assets which are NPA or which are stressed even now. And I don't think that will slow down for the next 2 years. The other thing, as I said, is the cash component might go up if the pricing is right, and we are starting to see that. So since our focus is on how much cash can be deployed, and our whole approach is how much can be deployed, which can earn, say, 18% plus kind of return. So earlier, let us say you are buying a 1,000 crore loan in an 85-15 structure, putting 150 crores to work. Now the same 1,000 crore, if you're buying it at 700 crore, but on an all-cash deal, you are actually putting 700 crores to work. So the amount of capital that you are able to put is much higher. So I think the cash component will go up. As I said, there are things like interim funding and all other opportunities that are opening up. And we don't see a problem for the next actually 3-4 years given the pipeline that is there in the bank even now. And now actually NBFCs are opening up. A lot of the NBFCs in infra space and all are also now coming forward and starting to sell. So even the NBFC market is starting to become fairly attractive.
Got it. Thank you. Those were my questions.
Thank you. We take the first question from the line of Vivek from GS Investment. Please go ahead. Vivek, your line is unmuted. Please go ahead with your question. As there's no response from the current participant, we take the next question from the line of Anusha Raheja from LKP Securities.
Yeah, thanks, for taking my question. Sir, any rough estimate how much ROE you would be making in your ARC subsidiary in FY19 and FY20 each on enhanced equity base?
So if you see slide 25, we have given the distressed ROE, which is about 20%.
That's for FY18, right?
Yes.
I'm saying how much, what I understand is nearly more than 50% of your book on the ARC is more than 5 years old now. So I guess those assets, little more than 20,000 odd crores should start contributing over the next 2 to 3 years meaningfully. So has that happened?
No, it is happening. I think 19 onwards, a lot of those assets. So like we look at recovery. So if you see our ARC slide, we have given a slide on recoveries out there. If you see slide number 35, slide number 36. We had recoveries of 2,500 this year. We are expecting about 8,000-9,000 crores of recoveries in this current year also. Of course, those will be recoveries from the AUM that we have, a lot of that will flow to the banks also. So we don't have any forward-looking ROE again on that. But as I said earlier, in the ARC business, when you recover, there is always some extra fees you make because of carry and incentives that will come through and start flowing through. in your ROE as you go forward.
So what I understand is if any recovery is more than 50% odd, then you might get a sizable benefit out of it. If it's less than 50%, I think that will be sufficient to take care of your, annual charges or the maintenance charges and everything. Is that so?
You usually get an extra pop or a carry when you recover higher than what you have bought it. So you bought something at 40 cents to a dollar, and when you recover more than 40 cents, you get a carry on that. So the general formula is if you buy something at 40 and whatever you recover above 40, about 20% of that comes to you as a carry. So let us say you recover 45, then you will get extra 1 because extra 5 to about 20% of that comes to you. So that is the usual rule of thumb.
Most of the assets purchased by you is around at 50% discount, I guess.
Our average purchase price is about 42 cents to a dollar. But again, this is very specific. There are assets we have bought at 80 cents to a dollar. There are assets we have bought at about 20 cents to a dollar. Our average price has been about 42, 43 cents to a dollar.
Okay. And so it will be difficult to put up some number there on the ROE side.
It will not be difficult. It is that we don't want to make any forward-looking statements on that. Because recoveries can come in this year, in next year, and which assets are getting recovered at what price. So we just don't want to make any forward-looking statement on that. As I said, as and when recoveries happen, there is usually an upside that an ERC gets.
Because so far, only 6% of the assets, have shown the recovery, as per the calculations. So meaningfully, they are yet to come.
No, I think if you see slide 36, our recoveries have been close to 4,000 crores in the last 3 years, and this 4,000 over the total AUM that we had is about 40,000 crores on an average. So we already recovered 10%, and I said we expect about 8,000-9,000 crores, another 20% recovery this year, and maybe hopefully 30% after that. So I think we already recovered 10% of the AUM in the last 3 years.
On the credit book side, some qualitative thoughts on the asset quality, of your wholesale mortgage book, because in the backdrop of, how you seeing things post RERA, and there has been relative drop in the prices as well. So, any stress is building up there, or how are you seeing the things there?
Actually, we are not seeing stress on the real estate side. In fact, commercial was always doing well. But in the last 8 months, housing has also been doing very well. So in spite of the headlines that come in the newspaper, we are seeing a fairly good sales. A lot of the projects we fund are also so there are 4 categories. There is affordable category, which is below 25 lakhs. We have a small book on that. There is what is called the economic category, which is from 25 lakhs to 1 crore worth of flats. A lot of our projects we have funded are in that category. In that category, we're seeing good sales. The third category is what is called the premier category, which is between 1 crore to 3 crore. And 3 crore and above is called the luxury category. The luxury market is still slow. We don't have a lot of exposure to that. But the economy and the premier segment has been doing well. In fact, the last quarter was a fairly good quarter from a sales point of view for a lot of real estate developers across India.
And just one last question on this ARC subsidiary. In the longer term, ARC will continue to remain as a subsidiary despite, CDPQ coming, as your partner. Is that the right assessment?
Yes.
Okay, fine. Thanks.
Thank you. Well, that seemed to be the last question. I now hand the floor over to the management for their closing comments.
Thank you all very much for your time. And as always, we are very encouraged by the interest in Edelweiss, and we hope that the extra 30 minutes on the call helped us address all your questions. And as always, if there are any residual questions, please feel free to contact either me or my colleagues Salil or Samriddhi, and we'll do our best to help you with your additional information needs. Once again, thank you very much for joining us on the call today.